So you spent decades saving for retirement. You did the hard part, right? But one of the biggest challenges isn't actually saving the money, it's figuring out how to turn that big pile of savings back into a steady paycheck. Okay, let's dive into this because the order you tap your accounts can make a massive, massive difference.
Right. So the big day finally arrives. Those regular deposits from your job stop, and now you have to pay yourself. You look at all your accounts. You've got your 401k, maybe a Roth IRA, that brokerage account, and you're faced with this huge question. Which one do I tap first to pay the bills?
And it might seem like it doesn't really matter where the money comes from, as long as it's yours. But this decision is anything but simple. Making the wrong move can set off this cascade of unnecessary taxes, slowly bleeding the very portfolio you worked so hard to build.
And we are not talking about a few $1,000s here and there. For a typical retired couple, say with about $1.4 million saved up, choosing the right withdrawal strategy versus a, let's say, less optimal one, it could mean a difference of nearly $500,000 over their lifetime. That is a serious, life-changing amount of money.
Okay, so to understand how this is even possible, we need to get organized. And really, the easiest way to think about all your retirement savings is to sort them into 3 different buckets. Each one has its own unique tax rules. Let's break them down.
First up, we've got the taxable bucket. Now think of your standard brokerage account here. You fund this with after-tax dollars, and when you sell something, you only pay taxes on the profit, the gains. And here's the best part. If you've held that investment for over a year, that profit is usually taxed at the much, much lower long-term capital gains rate.
Next up is the tax-deferred bucket. This is your traditional 401k or IRA, and for most people, this is where the bulk of their savings is. You got a nice tax break on the money you put in, and it got to grow tax-deferred for years. But here's the catch. In retirement, every single dollar you pull out is taxed as ordinary income, just like your old paycheck was.
And finally, the most powerful one of them all, the tax-free bucket. This is your Roth IRA, your Roth 401k. You already paid your taxes up front on this money before you put it in. So in return, all of its growth over all those years and every single withdrawal you make in retirement is 100% completely tax-free.
So here it is in a simple little chart. Taxable, taxed on gains when you sell. Tax-deferred, taxed on everything when you withdraw. And tax-free, never ever taxed again. Seeing it side by side like this really makes it click, right? You can see why the order you pull from these buckets matters so much.
Okay, so knowing what we know about these buckets, what's the most tax-efficient sequence? What's the secret? Well, financial planners have studied this a ton, and a kind of conventional wisdom has emerged that honestly works really well for most people.
So what's the optimal game plan? It's a surprisingly simple 3-step sequence. First, you tap your taxable accounts. Then, once that's used, you move to your tax-deferred funds. And only then, at the very end, do you touch the crown jewel, your tax-free Roth accounts. Now, this is the conventional wisdom for a reason, but think of it as your baseline strategy, not a super rigid rule for every single year. So the question remains, does following this order really move the needle?
Let's go back to that almost $500,000 figure and see exactly how this plays out in the real world. This example brilliantly illustrates just how powerful this simple little sequence can be.
So let's meet Phil and Claire. They're retiring a bit early, but they're planning to delay taking Social Security for a few years to really maximize their benefits later on. This creates a little income gap they need to fill from their $1.4 million in savings, which, conveniently, are spread across all 3 of the buckets we just talked about. We're going to compare 2 approaches for them. The first is what a lot of people might do, sort of a blended strategy, where they just take a little bit from each account every year. Seems logical, right? The second is our taxable first strategy, following that optimal sequence we just outlined.
And the result? Well, as you can see from the chart, it is absolutely staggering. By simply following the taxable first sequence, Phil and Claire's portfolio is projected to be worth nearly $500,000 more. Just look at the difference between those 2 bars. That's not from picking better stocks, that is pure tax savings.
So, how on earth is this possible? How can a simple change in the order you take your money out create that much wealth? Well, it all comes down to a very specific and often overlooked rule in the tax code that they can take advantage of in their early retirement years.
Here is the secret sauce. The U.S. tax code actually has a 0% tax bracket for long-term capital gains. So since Phil and Claire have no other income before their Social Security kicks in, their total income is low enough that they can cash in over $100,000 in gains from their taxable account each year and pay zero federal income tax on it. They are literally living tax-free in their early retirement, all by tapping the right bucket at the right time.
Okay, so that explains why the taxable bucket goes first. But what about the Roth? Why save the absolute best, most powerful account for very last? Well, the answer lies in the magic of tax-free compounding.
The logic here is actually pretty simple, but it is incredibly profound. Think about it. Every single dollar of growth inside your Roth account is a dollar you will never pay taxes on. So the longer you let that money sit and cook, the more it compounds and the larger that tax-free nest egg becomes. You're basically growing a pot of gold that the taxman can never, ever touch.
See, when you withdraw from your Roth early, yeah, you might get a short-term win of tax-free income, but you are making a huge, long-term strategic error. You are slamming the brakes on the most powerful wealth creation engine in your entire portfolio. You're not just taking money out, you're robbing your future self of all the tax-free growth that money would have generated for decades to come.
So as we wrap this up, the key takeaway is that sequence matters. It really, really matters. It's not just about how much you've saved, but how strategically you spend it down. Which leaves one final question for you to think about for your own plan. Which of your accounts is so valuable that it truly deserves to be touched last?